So let's talk about Philip Morris International, ticker symbol PM. It's a company that has a lot of very famous tobacco brands like Marlboro, IQOS, L&M, Chesterfield, and so on. And this is Philip Morris International, so it's basically everything outside the US. Inside the US, the company is called Altria. So let's see, is it an interesting investment opportunity at the current time? So, first of all, let's see who's investing in this company. Are there any insider buys? That's a negative. So, directors, CEO, CFO, COO, and all the other captains, they're not buying. So, it may be an indicator that this is not the right time to invest your money in this company. Now, super investors, that's a check. There are a number of investors and funds that are invested in this company right now. But if we look at the last quarter, they're actually almost all of them are selling this stock. What about the fundamentals of the company? Let's see the return on invested capital. That's a check, and actually this 35.5% return on invested capital is really impressive. This is a big check. This is really a strong indicator that the company is doing nicely. Now, what about free cash flow growth? And that's an X. We have a growth of free cash flow, but only 1.5%. Now that is really not a lot. So it's an X. We should try to find companies that have a free cash flow growth around 10% or higher. What about share buybacks? That's a check. In the last 10 years, they bought 7.9% of their shares back. It's good. It's some extra value that you get if you are a shareholder in this company. Now, what about dividend yield? That's also a check, and that's probably one of the main reasons people would invest in this company. That's a 5% dividend yield. That's really high, really nice, especially if we consider the fact that this is really a stable company. And most important of all is the fact that the amount of money they pay in dividends is about 68% of their free cash flow. So we are not in a situation in which the company is actually paying more in dividends than they have cash on hand. So this is a stable and safe situation. Now, what about the debt of the company? That's an X, because it would take them over 2 years with their current free cash flow to pay their debt. It is not a disastrous result, because we should look for something below 2 years, and it's only 2.2. But it may be a concern that Philip Morris International has a debt that they cannot pay really quickly. So it's a mixed situation. I would say that the return on invested capital and the dividend yield are the two really strong points of this company. So let's see the price to earnings ratio. So the current PE is 17.25. And if we compare it to a 5-year average PE for Philip Morris International, that's a check, because the 5-year average PE is 18.4, but it's such a small difference that actually it doesn't seem like Philip Morris right now is a cheap company. But let's look at the PEGI ratio. And PEGI ratio, that's PE divided by revenue growth and dividend yield. So the revenue growth of this company is really small. It's on the verge of being a 0.1. And the dividend yield, like we talked about it, is 5%. So if we take the current P, 17.25, and we divide it by 5.1, we get an X because the PEGI is 3.38. And what we are looking for is a number below 1, because that would mean that the growth of the revenue and the dividends combined together have more value than the current valuation of the stock market. But that's 3.38. That means that this stock looks really, really expensive. Okay, but let's do a proper valuation with a discounted free cash flow formula. So we have to put in some estimates of the growth of this company for the next 10 years. So we will have 3 scenarios: low, medium, and high one. So in the low scenario, the growth for the first 5 years would be 1% and then another 1%. Remember, we want to be conservative, because if we are wrong by being conservative, we get a bonus. We have some extra money in the bank. But if we are wrong by being over-optimistic, then we lose money. That is why we always try to be conservative while estimating the future growth rates. Okay, and the medium, let's say for the first 5 years 3%, and that they would keep it at 3% for another 5 years. And then a high scenario, a scenario that in which we believe that the company will do really well. So 4% and then let's say 5%. And for a tobacco company, a market that is actually shrinking, that would be a really, really good result. And the valuation, well, here it is. The intrinsic value is somewhere between $69.5 and $93. And if we apply a 30% margin of safety, which we always should do, the price that we should be looking for this stock is somewhere between $48.6 and $65. And as you can see, it's all red because the current share price is 99.7. So as you can see, Philip Morris International has really 2 strong points. That's return on invested capital, which is really good, and stable big dividends of 5% yield at the current time. But the price that you have to currently pay for this stock and other fundamentals of this company, they don't look that promising. So for me, that's an X. I would not invest in this company right now, though I absolutely understand that the fact of getting a 5% dividend yield is really interesting and can be a factor in your decision. So if you are interested in buying this stock, then please do your own due diligence and try to understand the company a bit better. Try to find information about their growth in different sectors. Because as we know, in the United States, their Altria, so that's like the American version of Philip Morris, is having some troubles with some of their products and changing the formula of others. Internationally, that's not such a big factor, but it probably will be in Europe. Certainly in the near future, they will have more and more problems with selling tobacco and nicotine. So that's it for today. I hope this was helpful. If so, then please like it and subscribe, and see you in the next one. Bye bye.